So in the last video, I alluded to this term called crowding out. So let's talk a little bit further about the burden of future generations due to this ever increasing national debt. So national debt can also burden future generations through a term called crowding out. So what is crowding out? Crowding out is essentially crowding out investments from businesses. Basically, businesses and households aren't going to be making as many investments. And how does this happen? Well, it happens one of two ways: through a term called direct crowding out and then indirect crowding out. So direct crowding out occurs when there is an increase in government spending. So the government is now going to spend more money, and they're going to replace private spending on a dollar for dollar basis. So instead of having private entities invest in certain regions, rather the government's just going to invest in it. Government's going to put money into it, and it's going to crowd out those private investments because basically the government's now investing in that on a dollar for dollar basis. So that happens whenever you have government expenditures beginning to invest in rail services or public transportation, rather than allowing private businesses and private entities to invest in transportation. The federal government comes in, invests, and turns it into public transportation. So that's whenever they're basically replacing private investment with government investment, and that's a direct crowding out. Or whenever the government begins to invest a lot more in healthcare and basically pushing the private investors out of healthcare. Whenever the government is investing in parks, and essentially whenever the government starts investing in a lot of these private or public goods that could have gone into private investment, they are directly crowding out those investments from businesses. Another way that they're going to do it, or it can be done, and it might happen for our future generations, is through this indirect crowding out. So as what happens is the government is actually going to be pushing up interest rates. That's going to be crowding out private investment that would have happened at a lower interest rates. So essentially what's happening is the government is going to be doing things that's really going to be raising interest rates. And as we've learned from previous videos and previous lessons, that as interest rates go up, businesses are actually going to be less likely to invest because they're not going to be making as much profit. So if they're less likely to invest, well, they're not going to be investing as much. They're just going to stop with those investments. And it's not because the government is directly investing in that. It's because of an indirect impact. And that indirect impact is those rising interest rates. So how does the federal government raise interest rates? Well, whenever the U.S. Treasury is going to begin to sell more securities, remember that we're selling those securities to offset that federal budget deficit. So when we're in those federal budget deficits, we're going to be selling more securities. And as we sell more securities, it increased the demand for funds in the money market, and it's actually going to be driving up those interest rates. So if the federal government wants to sell more securities, how do they entice more people to buy more securities? Well, they raise the interest that they're paying out. So that what they're going to be doing is they're going to be raising the interest rates on these governmental securities to entice more people to place their money in these government securities rather than investing it anywhere else. So as they're placing more money there, well, then the demands for funds in the money market actually go up, because people are going to be wanting to invest more and keep less cash. So it's actually going to be drawing money out of the economy, placing it into those treasury bonds. And on top of that, if a business realizes they could make more money with a steady, constant, secure rate of a treasury bond than going out and buying that investment, they're not going to be engaging in that investment. And it's actually going to be driving up these interest rates within the money market. And essentially it's going to be reducing the amount of investments that a business is willing to engage. So really what's happening with indirect crowding out is the interest received on government securities is going up because the government is trying to sell more in order to finance their federal budget deficit and finance the national debt. So they're driving up these interest rates, and what that's doing is that's telling individuals and businesses invest more in these U.S. Treasury bonds rather than engaging in other investments, rather than engaging in these private investments of just typical business investments. So we see less business investments going on. So what are the consequences of this crowding out phenomenon? Well, if there's less investments, there's actually lower capital stocks of manufacturing assets. So if people aren't investing as much, or not investing in businesses as much, then they really don't need as many of these manufacturing assets. So they're investing in less of these manufacturing assets. These manufacturing assets are also capital stock. It's capital stock of these manufacturing assets. And typically, these aren't going to be passed on to future generations. So let's think about this from a business standpoint. Let's say that you're getting ready to start up a business, and you want to start up this business and pass it on to future generations. And then you look at the interest received off of the U.S. Treasury bonds, and you realize I'd be better served putting my money in the U.S. Treasury bonds than investing in this individual business. So now I'm not investing in the individual business. So I'm not buying those manufacturing assets. I'm not engaging in that business. Or maybe I already have a business, but I'm not going to expand my business because I can make more money elsewhere. Or the interest rates are too high and I'm not going to be able to make a profit off of it. So I'm not going to expand my business, which means that this business that's not being expanded is not going to be larger for the future generations. So we actually have lower capital stock being passed on to the future generations. So these lower jobs associated with the operation of these investment goods. So if businesses aren't investing as much, they're not buying as much. If they're not buying as much, then we don't need to produce as much. If they're not producing as much, we don't need to have as many workers to produce those. So we actually have fewer jobs associated with these investment goods or these intermediate goods. It also reduces and lower future productivity. Remember how we were talking back up here? If we have the option to expand that business, but we don't, because we place our money somewhere else, because it's not going to be as we don't have as high of a probability of it being profitable. So we're just not going to expand our business. So we're not producing more. So we're going to actually result in lower future productivity. So kind of a quick overview. How does crowding out work? Well, government spending exceeds taxes. So that's the first thing that's going to be happening, is the government is going to be spending more than they're making. Because they're spending more than they're making, we have the national federal budget, or the governmental federal budget deficit occurs. We have a deficit in our national economy, or in our federal government budget. So because of that deficit, the United States government has to sell more treasury bonds. As they sell more treasury bonds, they're driving up the interest rates in order to sell them. So because of they're driving up the interest rates, now it's going to be harder. Now higher interest rates means that that investments are going to be less profitable. So these less profitable business or investments are now crowded out. They're literally being pushed out by these higher interest rates. And because of these, they're being crowded out by these higher interest rates through indirect crowding out. They're not going to be producing, or they're not going to be engaging in these investments. As they don't engage in these investments, we're not having to produce as much. As we're not having to produce as much, we're resulting in fewer jobs associated with these intermediate goods. As we have these fewer jobs and people aren't expanding their businesses, we wind up having this lower productivity.